Hey, all right, let's kick this thing off. Thanks everybody for joining us. We've got a big crowd today. Appreciate it. This is our second of our monthly production stream webinars. This is for June. This is where we talk about month over month changes in our production. So first things first, the team joining me today. I've got Oren, Julian, Trevor, Zach, and Gage. Thanks for joining me, guys.
Thanks for having us, Chris.
All right, let's get into some of these stories here. So for those of you who don't know what we do, here's what we are. We track a ton of data, and we're basically experts on volume through infrastructure from wellhead to demand. So how much volume is flowing and what that volume is worth. All right, here's our agenda today. First things first, we'll kick it off with Trevor. He'll talk about crude, gas, NGLs, and basically what we're seeing month over month changes in 25. And what we do believe is, you have one big market, but there's tons of opportunity within that market for you to make moves. Then we'll move over to Gage, WTI watch, volatility meets opportunity. We'll focus on the Permian, what's going on there, producer guidance, and then what's going to happen with these tariffs and change flows around the U.S. We'll go over to Julian for NGLs, ethane, butane, and geopolitics. Interesting week there. I guess it's been an interesting few months in that section. Then we're hopping over to Oren, who covers our Southeast and gas and Haynesville heat. We got rig activity and then LNG stress test. Plaquemines coming online. It'll be interesting. And then over to Zach, probably the biggest news, I think, in oil and gas, or at least the gas markets, was Tallgrass announcing a new pipe from the Permian up to REX. So the 4 routes, 1 future, and then Permian to REX. And then every month we're going to have a production scorecard, which is going to go by commodity, by basin, and show you our production changes month over month there. So let's jump into it. First things first, cross commodity production. So Trevor, bringing you in here, why don't you tell us what we're seeing here?
Yeah, moving from left to right on the slide, looking at crude oil production, this is the second forecast in a row that we have seen material downward pressure on crude oil volumes in the U.S. Current total U.S. production sitting at 13.4 million barrels a day. That's down about 112,000 barrels a day from what we were forecasting a month ago. And anybody who tuned into the webinar a month ago, we had a similar downward shift last month. So this is just related to the current WTI price environment that we're sitting in today. We continue to expect slower growth than what we had come into the year forecasting. And it's really related to producer activity that we are tracking as they react to current price environments. On the dry gas side of things, not a material shift here. We're sitting at 101.7 BCF a day. About just a note on the production, about 70% is made up from 3 of the regions that we're tracking, primarily in the Northeast, the Permian, and Arklatex. They make up about 70% of U.S. dry gas production. And then looking at NGLs, another pretty minor shift here. We are slightly positive, up 12.9 MBD. We'll talk a little bit more on the next slide about the Northeast, where we're seeing positive production change there, offsetting some across the rest of the U.S.
Oh, thanks, Trevor. Let's jump into basins that saw some material change that we should be watching here.
So just a note about this slide, Chris. Color coding here, we're just touching on a few of the basins, but the color coding is related to the products that are shown on here. So the red are primarily moves in crude oil forecast from what we were forecasting a month ago. Blue is talking about our natural gas forecast, and then the green would be our NGL natural gas liquids. So again, just touching on the crude oil, 2 key basins that saw the downward shift, about 30,000 barrels a day each out of the Permian and the Bakken. These are 2 WTI price sensitive basins. We are still seeing growth out of the Permian. They have a more resilient profile there where they've got lower break-even supplies. But in the Bakken, coming from where we came into the year to today, we've actually brought our 2025 growth forecast down to flat year over year from 2024. This is from what we were looking at a month ago. We have continued to see operators in the basin dropping rigs in real time, and we carried that through into our forecast. That's seen it come down about 30,000 barrels a day. Moving to gas, we were up overall, but we did make some adjustments to our Arclitex region, down about 0.6 BCF a day. And that's really just truing up to recent activity trends on the rig side as well. Just a note on gas, we do expect to see tier 2 basins continue to help balance the market in coming years. And that's going to be a response to what we view as a stronger price signal for gas. And then on the NGL side, Northeast was quite a bit higher this month, where it's making up for some other regions that were down. We adjusted our outlook, and that's really related to some of the top producers in the region have guided to flat volumes year over year. When accounting for that in our forecast, we're seeing some upward pressure in the Northeast.
Awesome. Thanks, Trevor. And again, we'll go through at the end just to show everybody what we're looking at by basin, by commodity, and changes that we have. But let's jump into some of the stories that we're looking at. We call this barrels, break-evens, and bottlenecks. So first, I want to bring in Gage on our crude side. And Gage, a couple of things. You have a lot, tariff talk, you have geopolitical politics, and then you have producer response. So can you tell us a little bit what we're seeing there?
Yeah, so I think the piece that we wanted to touch on here were how are producers and the midstream players kind of reacting to this lower price environment. So what we're ultimately seeing and what we've heard from the first quarter 2025 earnings results was that producers are maintaining their volumetric guidance through 25, but they're cutting their capital programs. And ultimately, the cut in capital programs is going to lead to a reduction in rigs. And so within the Permian, that's about 4% on average for the capital programs, and ultimately about 10 rigs. And so kind of with that in mind, the 2025 production is largely accounted for. The producers are tied into rig contracts. And so all of this is going to take months and months to materialize. None of it's going to happen overnight. So we'll see the volumes in 2025 show up, whereas we won't necessarily see it in the 2026. And so how does that affect the midstream players is that with the volume showing up and that these midstream assets are largely contracted and backed by MVCs, there's not a large upside to these assets, but there's not a large downside either. So ultimately that'll lead these midstream players coming into their guidance ranges.
Great. And how are you seeing this affect, the U.S. flows, call it infrastructure flows?
Yeah, so specifically related to imports, just kind of bringing it back to the tariffs, is that we're still seeing the Canadian and the Mexican crude oil enter in to the United States duty-free. So it's not really the tariffs that are impacting the commodity market itself. It's how the rest of the market is really reacting to the potential impacts of the tariffs, which is ultimately kind of driving prices down. And a piece of that is declining international demand, as well as the possibility of an oversupplied environment from OPEC plus. So what I really wanted to kind of show here is, and highlight the Permian, is that even in a sustained low price environment of, call it $60 per barrel, we're still going to see growth through the end of the decade. And that's largely driven by what Trevor mentioned earlier, was that lower break-even price. That's what we're seeing based on the WTI here.
Awesome. Thanks. Well, speaking of, and let's jump over to NGLs and bring in Julian, talk about geopolitics and tariffs. We had an announcement this week that I think was really interesting. So can you tell us a little bit about, one, what happened and what are we going to see from this?
Yeah, so Chris, what we saw is that ethane and butane have been elevated to the level of a national security risk. So what we've heard is that the Bureau of Industry and Security, the BIS, determined that these commodities, ethane and butane, could be diverted to end use by the Chinese military. So the impact of this has been that EPD Enterprise received a letter stating that they're no longer allowed to export ethane to China or to any Chinese-related entities without performing due diligence and obtaining a special export license. Kind of the question here is this going to stick? And the reason people have been questioning that is you can get ethylene from naphtha crackers or from PDH units at lower scales, but you can still get the ethylene. So the question is ethane really a national security risk, a military end use, or is this more of a high leverage play against China for a critical commodity that they can't replace anywhere else? And a lot of their petchem industry, all their ethane crackers rely on U.S. ethane.
Yeah, it's interesting. And we mentioned this on the last web. China gets all of their ethane from the US. Is that correct?
That's correct, Chris. And what we've seen is about 240 MBD on average since the start of 2025 of ethane has been exported to China, and all those volumes are immediately at risk. What I'd like to highlight the difference here, the difference between this and tariffs are the tariffs, your margins might compress. You could still, if you find the right arbitrage, you could still export and make money. For this, even if the economics support you shipping ethane, you're going to face legal and political consequences that you just can't overcome.
Well, it's going to be interesting to see where all that ethane and butane goes, and then prices here in the near future. So I know you're watching it closely. Appreciate that. Let's jump over to a very interesting one. Oren, I'm going to bring you in. Plaquemines, we've been following LNG for a long time. Plaquemines is obviously Venture Global, big. This was a big one coming online, and it's been pretty up and down. So tell us the story here.
Well, I'd say, yeah, Plaquemine LNG is pretty hot so far, drawing record volumes as high as 2.7 BCF a day, which is well above market expectations for this time during its ramp. This is putting stress on gas supply in the Southeast and driving significant price volatility in those Southeast markets. We expect this price volatility to actually intensify as we head into the summer months when Florida begins to pull about 5.5 BCF a day. And all of the eastbound pipelines in the region have run at near full capacity in previous years. And now we have 3 BCF a day or likely more of new demand at Plaquemine LNG. By our estimates, we can only really find about 2.6 BCF a day of available supply when Florida is running at peak demand. You can see from the graph on the left that daily feed gas flows are highly volatile, swinging as much as a BCF a day at a time between Tennessee Gas Pipeline in red, which pulls from the Northeast primarily, and TETCO and Columbia Gulf, which are pulling Haynesville gas from Western Louisiana. In our view, this is Venture Global stress testing its facility and its supply lines. However, as the Southeast warms up, basis premiums could get a little too hot for Venture Global to handle, and feed gas flows should stabilize a little bit, leaning more towards that Haynesville supply on TETCO and Columbia Gulf. Looking beyond 2025, we expect this flow volatility to calm down in probably around 3Q 2026 when Venture Global ends the commissioning process for this facility and begins commercial operations.
Awesome. So I want to bring something in here because we've been hearing a lot about our ramp of rigs in the Haynesville and Plaquemines coming online. You also have all this demand we're talking about. We were saying right around 60 rigs. I want to talk to you about that. Are we still holding firm? And this is a question from the audience real quick is, do we still think our forecast, the rig forecast is viable?
So we've actually brought our rig forecast down just slightly, but I would say we're still bullish on the Haynesville. We are calling for 53 rigs at the end of the year, and then ramping up for past 60 early in 2026 to help supply Plaquemines running at full capacity, as well as Golden Pass LNG, which is slated to come online starting in 2026. And so really you do need the Haynesville to ramp pretty quickly into all this new demand. And we run several different Haynesville rig scenarios. And let's just say if the big guys in the Haynesville don't show up, we're in for a seriously undersupplied market, and all of the fun price implications that come with that, meaning that we could see some of these tier 2 basins start to turn on production and take away Haynesville's market share.
So follow-up question that came through from the audience right now is, what price are we looking at to talk through that tier 2 ramp?
Well, I think probably around $5 to $5.50. You know, based on what we've heard from the Haynesville producers, they're not going to turn online before we see a 5 handle. And at that point, we do expect that some of those tier 2 basins are economical, and we should see production start to ramp up there as well.
Sweet. Keep those questions coming, everybody. If we don't answer them on here, we'll get back to you. Thanks, Warren. Appreciate it. And let's bring in Zach. We had a big announcement. Congrats to Tallgrass making moves here. They announced a pipe from the Permian up to connect to Rex. Can you give us a lay of the land?
Yes, absolutely. So with this project announcement, it's really the announcement of a precedent agreement that they've reached with a single shipper to support this project. And that precedent agreement is of an unknown size for an unknown customer. But they said that there'd be an open season that would follow. There would be 2.4 BCF a day of capacity from Permian supply sources up to connect with Rex, as well as some other potential interconnection opportunities. And this is capacity that they expect to be online by late 2028. So then that kind of takes us to our view of Permian production. If we're looking at the chart on the right, the dark blue shaded region is what we are forecasting for gas production out of the Permian. And the solid gold line is our current effective nameplate capacity of egress out of the Permian. The addition of the Tallgrass project gives us that dark dotted line. And when we look out to that 2028 and 2029 window, the addition of this Tallgrass project gives us 6 BCF a day of excess egress nameplate capacity. That's putting the Permian in a pretty solid overbuild state. Given that there could be an overbuild, it would put downward pressure on the basis between Waha and Henry Hub, because with all the optionality out of the basin, we'd expect those price points to trade at a closer parity. And given that there'd be more close price spread between Waha and Henry Hub, you would see kind of rate risk on some of those legacy Permian pipes like PHP or GCX that each Kinder Morgan and Kinetic have stakes in. In addition to the rate risk, there's some volumetric risk as well with optionality out of the basin.
Awesome. Well, it was a big announcement. The one thing they didn't announce, though, is where is this going? So let's get your thoughts and bring you in. I know you ran some scenarios here. Can you walk us through those?
Yes, so we see 4 different scenarios. So we're going to be moving from left to right on the screen, or from westward most option to eastward most option. Beginning with option number 1, we're just calling this the western route, where we would follow the existing right-of-way of Transwestern or EPNG up to the Four Corners area, and then connect with the southernmost terminus of Rex in Meeker, Colorado. This would be a really interesting option just because there's not a lot of pipes that kind of follow this corridor, and we see a large amount of growth from data centers and power gen that's developing in the desert Southwest. The second option is kind of the path of least resistance, where you just be building due north out of the Permian, and you would connect kind of in this western Nebraska region. And this would give you strong optionality to enter either Western markets or Midwestern markets, depending on where demand is pulling at different times of the year. The third option is a route through the Mid-Con, following kind of existing routes offered by NNG and NGPL. We are a little hesitant to think that this is the option that Tallgrass would be pursuing, because NNG and NGPL are seasonally underutilized, and there's latent capacity that would be available for shippers to pick up on these systems. So we doubt that they would offer an option that could already be accessed through existing latent capacity. And then the easternmost option is this route that would connect with REX in the Mexico, Missouri area. When we look at flow points in Mexico, Missouri, they're very volatile. And that is because REX sources a lot of gas from the Northeast. And then seasonally, the Chicago markets place a huge pull on that demand. So not much gas makes it west of the connection with REX and NGPL in the winter season. So there would be a lot of value in shoring up the supply to that area that is sucked up by Chicago in the wintertime.
Well, thanks for walking us through. We did have a question come in around which one, if you were to rank them, which two do you think would be the most viable option? But I do want to just clarify, these aren't ranked currently in order, they're just ranked left to right.
Correct. Yeah, they're just numbered left to right. But if I had to pick one that seems most viable, I think this, like, the layup commercial decision is just you build straight north. From a cost perspective, you're laying the fewest mileage of pipes. It's easier from an engineering perspective to just build that short distance through a right of way that you wouldn't experience a lot of political challenges to. And then you still offer market optionality into the Midwest or the West. I do think that the first option, the westernmost route, is very intriguing. Just because there's a lot of demand developing in the desert Southwest region, and building along this transwestern EPNG corridor gives you the ability to access those markets and subsequent capacity offerings. But it does offer more risk where you're building it through and around the Rocky Mountains, which is definitely challenging from an engineering and permitting perspective.
Awesome, thanks. A couple of things I found interesting. One, a lot of things surrounding the Mid-Con and the Darko with this pipe with number 2 that goes through. And with number 1, we saw a jump in rates in the San Juan here in the last week or two. So that's very interesting.
Yeah, we've seen a jump in rigs and also indications of some pretty high IP rates that those wells are capable of. So it's kind of a basin that hasn't seen a lot of attention, but could be a future lever that is very important to adjusting dynamics in the gas markets as demand expands.
Awesome. Thanks, Zach. Appreciate it. Let's move over. I just want to give a brief look at our cross commodity production and by basin. Trevor, I'm going to bring you back in just to maybe explain it a little bit. There's not, I think it's pretty self-explanatory, but basically this is crude, and we're just looking at the major basins, crude basins, and what they're doing on a month-over-month change for 2025.
Yeah, this is just more transparency to the data that we are tracking ourselves and what we're sharing. So we touched on a couple of the key basins earlier in the presentation, but here in the back of the deck, we've got more transparency to that. So it shows you really on the crude side from where we were a month ago to where we're sitting today. We got 3 big movers on the basins. We touched on the Permian, the Bakken. The Mid-Con is also materially down again, related to activity changes that we're seeing in the basins.
Thanks, Trevor. And we're not going to spend a lot of time here. We do have natural gas here. You can see the changes. Reach out to us if you have questions. And then, you know, some interesting things in the Northeast going on with NGLs. And please reach out to us, Julian, if you have questions there. So I do want to wrap this up. Sign up for our free newsletters. And I think you'll find them very valuable. And then here's the team. Here's the team that was on today. And how we like to close this out is I like to ask everybody, what are the 1 or 2 things that you're watching over the next month before our next webinar? So, Oren, you're the first one on the screen. What are you watching?
I'm watching storage injections. We are approaching a potential record number of triple-digit injections in this injection season, and that has pretty significant implications for prices in 2025, as well as production response to LNG later this year.
Awesome. Thanks, Oren. Julian, NGLs have been really interesting. You've had a busy couple of months, but what are you watching moving forward?
Yeah, watching moving forward, Chris, we're watching just NGLs on the water, energy flows on the water. As you know, kind of these situations develop, and we're seeing more and more that energy is being treated as geopolitical weapons and kind of used for leverage in many different decisions, and that changes drastically the flows and where they're going.
Awesome. Thanks, Joanne. Trevor, what about you?
Yeah, I'm interested in seeing how all the markets, but particularly on the production side, how producers are going to continue to react to the current pricing environment, political environment, tariffs, et cetera. What actions are they going to take?
Awesome. And then Zach.
I'm pretty curious about how producer expectations and subsequent production outlooks will be changed in regard to some of these infrastructure announcements. Looking back at that Tallgrass story, we're projecting the Permian to be significantly overbuilt. But if there's real demand on the other side of these new infrastructure projects and contracts that back them, the producers are going to find a way to target more gaseous plays. Oren and I were running a scenario today where if we add just 5 rigs onto the Alpine High system, which is much more gassy in the Permian, you could get up to a BCF a day of incremental production. And this is a system that we've seen support 8 to 12 rigs before. So 5 isn't a crazy number for it to be operating at.
Fun to watch. All right, Gage, no pressure. Everybody remembers the close here. So I'm putting it on you. What are you watching?
All right, well, really watching to see whether WTI hits $70 or if it hits $50 first. And ultimately, if it continues to decline, do we see some more production out of the Northeast or in other subsequent basins rather than the Permian for some associated gas?
Where's it going? 70 or 50? What are we doing, Gage?
We'll see. It's on upward trend right now.
All right, I'm always bullish. I think it's going to 70, although we had an internal bet on where it was headed. I lost miserably, so that's all right. Hey, everybody, thanks for joining us. Audience, thanks for joining us. Guys, thanks for being with us here today.
Thanks for having us.
Thanks, Chris.